This is the weekly FinTickAI Report, analyzing the Indian equity market. The National Stock Exchange, or NSE, navigated a tumultuous period in the final week of February 2026, culminating in a significant technical breakdown on Friday, February 27th. We see a conflict between economic resilience and global sentiment. The domestic economy showed exceptional resilience with 7.8% Q3 GDP growth. However, equity indices were weighed down by deteriorating global sentiment and persistent institutional distribution. The NIFTY50 index concluded the week at 25,178.65, a 1.25% decline in its final session. This snapped a brief recovery attempt and closed below the critical 25,200.3 psychological and technical threshold. The downturn was characterized by a sharp sell-off in heavyweight sectors like banking, automobiles, and telecommunications. Concurrently, the India VIX jumped nearly 5% to 13.70, signaling an escalation in market anxiety and volatility. The market environment is shaped by a complex interplay of localized border conflicts, specifically the conflict between Pakistan and Afghanistan, and the broader failure of international diplomacy in the US-Iran nuclear negotiations. A liquidity confrontation occurred between foreign institutional investors, or FIIs, and domestic institutional investors, or DIIs. FIIs engaged in an intensified selling spree, offloading nearly 7,536 crore. DIIs provided domestic cushioning with a net purchase of over 12,292 crore. Despite DII support, structural damage suggests the path of least resistance remains downward. The NIFTY50's technical configuration transitioned from high volatility consolidation into a confirmed corrective breakdown. The index formed an NR4 pattern, or a 4-day range contraction, within the 25,350 to 25,900 range, which often precedes an explosive directional move. The explosive move realized on February 27th was decisively bearish. The index breached both its 200-day simple moving average, or SMA, near 25,502, and its 200-day exponential moving average, or EMA, near 25,604. This breach is structurally significant, as the 200-day EMA historically defines the line between a primary bull market and a corrective phase. Oscillator analysis reveals a deepening bearish bias. The 14-day Relative Strength Index, or RSI, for NIFTY50 slipped to the 28.6 to 40.0 range. Meanwhile, the Moving Average Convergence Divergence, or MACD, remains entrenched below its signal and center lines, reinforcing the strong bearish indicator. The pivot level synthesis highlights immediate overhead supply zones that will cap any recovery attempts. The psychological floor at 25,000 represents the next major support. Technical analysts expect the 24,950 to 25,000 zone to be a site of fierce battle between short sellers and long-term accumulators. Analyzing the Bank Nifty and financial services performance, we see divergent trends. While the banking sector showed a divergent technical profile relative to the broader NIFTY50, it succumbed to the broader sell-off on the week's final day, declining 1.08% to close at 60,529.00. The Bank Nifty RSI remains robust at 50.7, suggesting a moderate bullish bias. Its relative strength and sectoral leadership are reaffirmed by the Bank Nifty ratio chart, climbing to a 33-month high. This suggests the banking sector is losing less value than other sectors. Despite relative strength, heavyweights are under pressure. Banking giants like ICICI Bank and HDFC Bank saw significant intraday drops. The Nifty Financial Services Index mirrored this weakness, declining 1.55% to 27,869.75 due to players like ICICI Prudential Life and SBI Life. A review of banking constituents shows key players like HDFC Bank and ICICI Bank contributed to index drag. A critical insight is the ongoing shift toward public sector undertakings, or PSUs. The PSU Bank Index strongly outperformed frontline indices, surging over 5% during the week. Geopolitical narratives have shifted market sentiment from cautious optimism to risk-off. The primary geopolitical driver is the failure of the US-Iran nuclear negotiations, raising fears of military confrontation and OPEC supply disruptions. Regional instability, triggered by Pakistan's Operation Ghazab-ul-Haq, has introduced a neighborhood risk premium. Additionally, U.S. trade policy uncertainty due to the lack of clarity on Trump-era tariffs has delayed a potential trade agreement between India and the U.S. Domestic sentiment was bolstered by 7.8% Q3 FY26 GDP growth. However, external stressors like concerns about global liquidity and geopolitical security outweighed domestic economic fundamentals. The rise of the India VIX above 13.50 confirms volatility is a central feature of the current trading regime. Institutional liquidity remains a site of conflict between global capital outflows and domestic buying. Foreign institutional investors, FIIs, were consistent net sellers, selling equities worth over 7,536 crore on February 27th. This systematic distribution targets high-weighted stocks, pressuring the benchmark indices. Net institutional flows show that on February 27th, FII selling of 7,536.36 crore was cushioned by DII injection of 12,292.81 crore. This domestic support prevented a total market collapse. Despite net positive institutional flow, the NIFTY50 dropped 1.25%, indicating selling pressure from retail panic or algorithmic stop-loss triggers. The global economic outlook highlights U.S. stability amidst a synchronized slowdown. Dominant structural themes for 2026 include the inference phase of AI and the U.S.-China geopolitical power race. The U.S. economy shows stability, though sensitive to Trump-era policy headlines. Goldman Sachs forecasts U.S. outperformance, but the elevated DXY is pressuring the INR. This video will now feature a series of charts related to the Nifty50 index. We will analyze the price action and key technical levels. This chart illustrates the weekly Nifty50 index performance, emphasizing the sharp decline observed at the end of the trading week. Here we see the Nifty50 daily chart, providing a closer look at the price movement and volatility leading up to the technical breakdown. The Nifty50 hourly chart further dissects the intense intraday selling pressure experienced during the final sessions of February. This slide displays the daily chart of the Bank Nifty index, showing its recent trend in closing position. This chart details the Nifty Financial Services Index, highlighting the decline and overall weakness in the financial sector. The daily performance of ICICI Bank is shown, one of the banking giants that contributed significantly to the index drag. This chart illustrates the daily price action of HDFC Bank, another major heavyweight under selling pressure. We see the chart for State Bank of India, which demonstrated relative resilience compared to its private sector peers. This slide features the chart of Punjab National Bank, an example of a public sector undertaking that outperformed during the week. This chart represents the daily performance of Tata Motors, reflecting the sell-off in the automobile sector. We are looking at the daily chart for Reliance Industries, a key market heavyweight and indicator of broad market trends. This chart displays the daily movement of Infosys, a significant player in the IT sector. The daily chart for ICICI Prudential Life is shown, which contributed to the weakness in the Financial Services Index. This slide presents the daily chart of SBI Life Insurance, another insurance player affecting the financial index's performance. This chart visualizes the US dollar index, or DXY, highlighting its elevated level and the pressure it exerts on the Indian rupee. We examine the chart of the India VIX, illustrating the significant jump in market volatility during the week. The chart for Brent crude oil prices is displayed, relevant due to geopolitical tensions in the Middle East and concerns over supply disruptions. Finally, this chart provides the daily price action for the U.S. 10-year Treasury yield, a benchmark for global interest rates.